I think it's really important that folks take a look at where they have put their retirement savings. Okay, because by far and away the majority is in what are called tax deferred accounts, right? 401ks, IRAs, SEP IRAs, right? Retirement plans. And it's in there in the word, it's tax deferred, right? They're not tax mitigation accounts or tax free accounts. They're deferred accounts. People went to work 20, 30 years ago, owed taxes, didn't pay them because of a loophole in the tax code under section 401k that said, if I put it in this special tax shelter account, I can defer my taxes and pay them later. And so for folks looking at retirement, later is coming now, and they need to have a plan. And no one accounts for this, and it's not on our statement, unfortunately. Like if I ask somebody who had, say they have a house worth $900,000, right? And they had a $400,000 mortgage. Okay, and I said, well, what is the equity in the home? They would tell me, what would you say the equity in the home is? 500,000, right? Obviously. 100 out of 100 people would tell me that. However, if we had a 401k, right, with $900,000 in it, and I said, how much equity is in your 401k? 100 out of 100 people would tell me 900,000. But they owe a large mortgage to the IRS and state governments, and they have no idea how much money they owe or how they're going to pay it back. I mean, even really astute people who are focused on paying down their debts owe a massive debt to the IRS and their local state governments, and they have no idea how much they owe or how they're going to pay it. Right? And this is a big part of retirement planning, because what's likely is the math is about the same. Right? And so it all depends on what this tax rate is, of what you're going to pay, how much of this money in tax deferred accounts is actually yours. Right? So we're going to teach people in this class about things like Roth IRA conversion and the optimum years and strategies that they can do that, so that they could hopefully whittle down this number that they have to pay to the IRS and maximize the equity that they have in their tax deferred account. So unlike a mortgage, right, where the bank is dictating the terms, you actually dictate the terms of what this rate is going to be, right? Are you going to be taking this out at a 10% rate, a 15% rate, 25, 35? Are you going to be taking this out at a 10% rate, 15%, 25%? 50%, right? It all depends on what your strategy is and when you're taking out that money, how much you take out each year. And it's just math. We can plan these things. We teach people how to do that in this class, and how to use this very valuable loophole called Roth IRA conversion, which we can actually convert tax deferred accounts that have this mortgage to the IRS to tax-free accounts that have no liabilities to the IRS and state governments.